morning, everyone. Commissioner Garcia Richard.
Here.
Treasurer Eichenberg.
Present.
Secretary Romero.
Here.
Tim Jennings.
Here.
Harold Lavender. Lee Rawson. Mike Messina. Nick Tejas.
Hi, it's Kathy Allen.
Thank you, Ms. Allen.
Did you get Lee? You're awesome.
Thank you, Lee. John Bingaman.
Here.
Thank you. Let me go back to the people I did not hear from. Mike Messina. Nicholas Tejas. Harold Lavender. Well, you do have a quorum, Madam Chair, and I'm assuming that the others will still be joining us.
Great. So we will go to agenda item 1B, which is approval of our agenda. Just want to remind members that we did get some adjustments that came in the manner of an additional voting item on agenda item 3G, which is termination of 2 contracts and 1 renewal of a contract. So I hope everyone has received those updates. I believe they're in the back of the diligent book. I move we approve. All right. Kathy. Thank you, Member Allen. So we've got a proper motion. Do we have a second?
Second.
So we have a motion by Member Allen. I believe a second was by Member Rawson.
Correct.
And we're going to do a roll call vote on approval of the agenda.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Harold Lavender. Lee Rawson.
Yes.
Tim Jennings.
Yes.
Kathy Allen.
Yes.
John Bingaman.
Yes.
Let me see if Nicholas Tejas, have you joined us yet? Or Mike Messina?
Probably like a 7-0 vote?
A 7-0, yes, thank you.
Okay, great. We'll go on to approval of our minutes from our March 23rd meeting. Any discussion on that item? Is there a motion?
I move to pass it.
All right, we have a motion from Member Jennings. And Kathy Allen, second. Okay, and a second from Member Allen. If we could call the roll on a motion to approve our March minutes.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
I'm going to abstain. I wasn't present.
Okay, thank you. Lee Rawson.
Yes.
Tim Jennings.
Yes.
Kathy Allen.
Yes.
And John Bingaman.
Yes.
That's 6 in favor and 1 abstention.
Okay, very good. With that, we'll move on to agenda item 2 and turn it over to our State Investment Officer, Mr. Moise.
Thank you, Commissioner, and good morning, everyone. Starting with item A on my briefing sheet, the current net asset value, $33.230 billion. And I think you'll find it interesting that as of yesterday, we have hit an intra-month high of $33.252 billion. Looking at total distributions to the state, we have a number of $1.60 billion over the last 12 months. West Texas Intermediate oil, an interesting few numbers that I think are worth mentioning. As of close of business last night, WTI was at $61.92 per barrel. The New Mexico price, $58.69 per barrel. And that was as of April 23rd. So when you look at that, along with our rig count, the total rigs as of April 23rd this year, 71. As of April last year, 87. As of March 2020, we were at 114 rigs. So it's likely that the changes in rig count were probably pandemic related, but those numbers are worth following. Continuing on with the SIO briefing, under distributions, you can see the numbers and how they have grown. The total 10-year distributions, almost $9 billion. Vince will be covering investment performance. He will also be advising you on the contract matters that appear under item 3G, as the commissioner mentioned, of the agenda. And all of you have revised agendas, as well as several memoranda from staff and RVK that were sent yesterday. We have a new graph that Carrie has added to the dashboard that I think is instructive. If you'll look at the dashboard, the second box down from the top on the left-hand column of the first page shows land grant and severance tax fund net asset value and distribution growth. And I commend that to you. I think it tells a story that is worth understanding. You'll also see on the second page, under administration, we have 31 authorized FTEs. That number is being reduced to 26 as a result of the most recent changes. We currently have 24 positions filled. We are looking for an additional accounting analyst and a communications analyst, and we will be filling the HR professional role either internally or externally, because the state personnel office is no longer going to be providing outsourced HR services to agencies. Looking back, if you will, at the briefing, under item C, you'll be hearing from the audit committee in their report concerning a new chair selection. As a result of the orientation that we recently conducted with new council members, Mike Messina is the only remaining member of our governance committee. Member Allen expressed a strong interest in serving on that committee and re-energizing it, if you will. And we even had comments from Secretary Romero with an interest in certain things that can be explained to you a little bit later. We'll see how that progresses. Under external relations, I'm going to ask Charlie to comment on many of these things, but let me just start with a report to you on the New Mexico Recovery Fund. The final deployed size of that fund, which was authorized to go up to $100 million, will likely end up at about $87.5 million. There are 5 borrowers approved in the deal pipeline currently in legal analysis. And if those are approved, we will likely get up to that $87.5 million number. The fund has currently funded loans of $70 million, and that is 25 loans. So if we need more detail on that or color, we'll ask Charlie to provide that. And I'll also ask you, if you will, Charlie, to comment on the Small Business Recovery and Stimulus Act with the New Mexico Finance Authority. We have a new memorandum of understanding with them. That's a $500 million amount. And Charlie, also, if you will, on the proposed Sustainable Economy Task Force and client matters. Charlie?
Thank you, Steve. I think I'll start off basically with the clients. We have seen a fairly marked increase in inquiries from current clients and potential clients. It could just be that the markets and the economy is in the news, but a lot of people are looking for options for their investment dollars. The inquiries include a state university that is not yet investing with our pools. Most of the state universities are. That's Western is inquiring about partnering with us. There's a state agency that is expecting an influx of long-term investment capital. And there's also been some initial inquiries regarding long-term investment by somebody representing New Mexico municipalities with these are smaller cities and towns with less than 65,000 residents. All the discussions are in the early stages, and DFA has to sign off on any new JPAs that we might enter. Other discussions with existing clients, mentioned those briefly. Staff recently updated the Board of Regents for the New Mexico School for the Blind regarding their investments. The school is the second to invest in the SIC's private market pools, along with Retiree Healthcare Authority. The third client, New Mexico Tech, they're our second biggest client. They've got about $115 million invested with us currently across 7 separate accounts. They are working with external advisors to potentially develop an asset allocation that would put them about 30% into the private market pools. Currently, we have 23 clients, and they're investing $1.6 billion. Just for a little bit of reference, a little bit of perspective on that. 10 years ago, in April 2011, we had 17 clients with $531 million, about a third as much. That's it for clients. The $500 million program that NMFA is managing for us related to SB3 and the New Mexico Recovery Act, that they are rolling out. They've had some initial media press on that, and I know they're trying to get that system up and running with the new expanded rules that allow for more small business loans at a greater quantity. And Steve mentioned that we did update our MOU with them. And so, Madam Chair, I think I don't have anything else on the Sun Mountain New Mexico Recovery Fund. I think the $87 million, if we get there, I think that's a very positive development. There are still 5 negotiations ongoing. The program has done what the council wanted it to do when they initiated it last March. Madam Chair, no other comments from me, but I'm glad to take questions.
Steve, is that all for your remarks as well?
Just to update everybody on the fact that we haven't heard anything more on the legislative request that we join with several other agencies on the Sustainable Economy Task Force. It'll be headed up by the Economic Development Department. As soon as we know more about that, we'll let you know. Commissioner, that is all I have.
All right, thank you so much. Questions from the council on our SIO report? Yes.
Commissioner, anyway, just one comment on the oil and gas rig thing. When you look at that count, there was a great deal of concern. To me, I have some concern on when they froze all the activities at the BLM and everything. I had several companies contact our family holdings about, moving to drill ahead and drill up everything they can now before something else happens. And we had one company that came and, they went and, they permitted 8 wells because it's the only ones they had, and they didn't want something else coming and going wrong. So the rig count thing could have some very significant effects on New Mexico drilling, and on what's going on there. People should be aware that if the BLM starts freezing stuff out, we have so much. The BLM has so much effect on New Mexico's lands out here in the southeast that it could cause significant problems.
Yeah, we're seeing a similar trend, and we're have some of the same concerns, Member Jennings, at the State Land Office.
Okay.
Madam Chair, this is the other Tim. Can I ask a question?
Mr. Treasurer, yes.
Thank you. Hey, I was looking at the dashboard and the contributions from the State Land Office. I noticed in 19 and 20, you kind of exceeded what the distributions were to the beneficiaries. How far behind are you in 2021? I mean, what month are you reporting from?
Surprisingly, we're kind of on track. So we're going to close out this month, and remember, we're 3 months behind. So right now, we're reporting on January, our actual January returns. So we are looking to close out this month probably around 100 million. It's going to break 100 million, and so it's looking like another $1 billion year for this FY 21 year for us. I mean, it's amazing, but our production on state land is continuing to hold that high watermark.
Okay, and then, Madam Chair, could I ask Steve, is that number going to change on the beneficiaries, or is that what's already projected from last year or this year?
Is the total amount of distributions going to change for the next fiscal year? Is that your question?
Well, yes, I didn't ask it properly, Steve. That's already a projection from last year, right? This is what.
Yes, that's correct.
Okay. Thank you. And what a great job you've done. Holy Toledo, over the last 6 years, it's grown considerably. So, good job. Do you have that?
Mr. Treasurer, let me just comment on that, if I may. We're going to be presenting to the Investment Committee and the Council next month a little bit more in-depth analysis of where the inflows that are making up the increased net asset value are coming from. I think you'll find that interesting, so stand by for that.
Okay, great. And Madam Chair, keep up your good work, because if you keep bringing in as much as we're sending out, it's only going to continue to grow. So thank you for the work that you're doing as well.
Thank you. Madam Chair? Member Romero, I think.
Yes, it is. Thank you very much. Just back to Mr. Moise's comments about an HR and SPO pulling back. I don't know that that's going to happen. I think there were some discussions. I think they were planning on doing that, but I think they may be changing course. So, Mr. Moise, before you take any action on trying to fill that position, let's have a conversation.
We appreciate that. Thank you, Secretary.
see you get inside information, Steve. That's pretty good.
We appreciate having each of you on the council. Honestly, it gives us a lot of heads up that we need.
Any further questions on the SIO report before we turn it over to them? All right, Vince, are you ready?
I am. Thanks, Madam Chair. So I'll be brief here. Not a great deal is changing from my previous reports too. The economy continues to recover. Of course, we've pumped more than $3 trillion into it in various ways, and that's a big shot in the arm in terms of total size of the economy. But we're seeing great numbers. The firms that we use for their econometric models are still showing between 6 and 7% growth here in the first and second quarter of the year, and between 4 and 5% growth on a real basis for here in the U.S. for the year, projected for the year. So really good numbers. States are slowly reopening increasingly, so people are getting back to work, and activity is very high. Not necessarily the same in the rest of the world, particularly the emerging markets. Vaccinations are going a little bit slower there, and there's been some recurrence of the COVID-19 and keeping their economies moving a little more slowly. And they didn't quite have the resources to pump into their economy like we have here in the U.S. So it's a little bit slower, particularly in emerging markets overseas. Of course, financial markets are responding, in a positive fashion, particularly stocks, and we're still seeing good returns. When we get to the March performance report, you're going to see some big numbers in there, 24.5% on a total fund basis. Land grant tends to run another 75 basis points or so ahead of that, so we'll be over 25%, most likely for land grant incentives. But we'll get to that here in just a minute. A little bit concerned about inflation still. We are seeing some inflation in the commodity markets, particularly, and in some of the other areas of the economy. So we're keeping our eye on that. See how that can develop. Of course, we developed our real assets portfolio, and some assets in the fixed income portfolio respond positively to increasing inflation. So we've got a little bit of a hedge in terms of our investments. But that's all for my report. And if you like, Madam Chair, we can just turn right over to RBK, and they can walk us through the notes of the performance.
Let's see if there are any questions first, Vince. Thanks. Any questions for Vince before we go to Marcia? I don't know if it's Marcia Martias is on with us. Okay.
We are.
Yep. RBK can take over.
Okay, great. Thank you, Madam Chair, and Vince for the comments. Good morning, everyone. As Vince mentioned, today we have the February and the preliminary March results in the packet that we'll be discussing in some detail. I'll just offer up a few capital market comments. Vince already touched on a lot of them, but hopefully they'll be helpful in terms of framing some of the underlying portfolio details. As was mentioned, as I'm sure you know, global equity markets are continuing to do very well, and that continued through March. A lot of generally positive economic data and fairly resilient investor confidence contributed to that, and we saw just for that short period, low to mid-single digit returns. So this last 12 months has been highly unusual, as we've been talking about. A lot of it is the result of the COVID-induced sell-off a little over a year ago now. And we've recovered most of that and then some in a lot of parts of the market. One of the things that has changed over the last number of months is value, continuing to outperform over the short period. But that is a change in style leadership that was certainly overdue. And the difference that remains between growth and value is still quite wide. So it's nice to see value doing better, but there's a long road ahead in terms of value catching up to growth over that past decade. It's been mentioned that in the international equity space, things weren't quite as good, and saw a bit of a pullback at the end of March. Most of that due to increases in more COVID cases. They've had a more difficult time getting vaccines available and out. So that's been essentially resulting in more lockdowns, additional lockdowns in terms of trying to limit the spread. And by the time you couple that with a fairly strong dollar, we tended to see some relative weakness, even though the quarter certainly was still positive and accretive to total returns. Vince mentioned inflationary pressures. Those certainly have been there, although we really haven't seen inflation ticking up, and we've talked about that in the last few meetings. Part of that is the economy reopening. We would expect some inflationary pressures, and that ultimately led to the 10-year Treasury rising almost 1% from 0.9 to 1.7. Not a lot, still relatively low rates, but a big increase on a relative basis. That increase in interest rates proved fairly challenging for fixed income markets. Last year was a very strong year for fixed income, one of the highest returning asset classes. This year to date, fixed income is more challenged again, as we talked about interest rates and price and the bond market move inverse. So we actually saw quite a few sectors delivering negative returns in that first quarter. Higher yielding, though, and lower quality issues tended to do quite well and actually produce positive results. And when Marcia reviews your core and non-core exposures, I think you'll see that. So there's certainly value in having that level of diversification. Commodity markets, a number of folks have already touched on that, but those are on an upward trajectory. Again, still quite a way to make up in terms of what has been given up over the past year plus, but they are generally supported by higher global growth expectations, and hopefully that is continuing, and that flows through your real assets portfolio certainly, and you can also see that in some of the more near-term results for the MLP portfolio. So I'll just stop there, see if there's any questions, and then we can transition into reviewing the actual portfolio results.
Questions from council? Matthias, if I could just remind you to cite your page numbers. I'm a little bit lost right now.
Yeah, absolutely. On these monthly flashes, we really only have a very brief one-pager that's at the end of the report. So these are just broad observations that I'm making, not necessarily referencing anything in particular on the page.
But I'll take you to page 43 in your diligent book. And we're going to look at preliminary performance for March. There is February performance in your book, but we thought we would take you to the preliminary numbers as of the end of March. And again, that's on page 43 of your diligent book. It's page 2 of the RBK report. And this preliminary report is for the total fund. It's before we have the information to break it out between land grant, severance tax, and early childhood, et cetera. So this is total fund, but you had a very good month. The total fund was up to the month 2.62%. Calendar year to date, or the quarter, preliminary numbers are at 3.84%. Fiscal year to date, 17.7, and then the number Vince referenced, your 1 year number is over 24.5%. So strong markets, strong recovery. I thought it would be interesting to talk about how far we've come since last year. Last year, March 2020, for the month of March, you were down over 6%. That translated to a negative return for the first quarter of 2020 of 9.4%. And at that point, your fiscal year-to-date return was a negative 5.06. So bounced back after March. And for the most part, it's been pretty strong since. And again, reflecting that 24.5% return for the 1 year number. Really unexpected strength
If you go to page 44 of diligent, we can look at those numbers again, but also look at your composites, your global equity composite. We look at your traditional equity, your publicly traded equity. It was up 2.63 for the month, up over 5.5% for the quarter, and your fiscal year to date is over. I'm looking at fiscal year to date for global equity was just under 32%. For very, very strong numbers. If we break that out between U.S. and non-U.S., as Matthias mentioned, better market for the U.S. For the month, up 3.49 for the U.S. equity composite. But look at that 1 year number. Since March of last year, your U.S. equity has returned over 61.5%. Now, you trailed the benchmark slightly for that 1 year period, but we've talked about reasons why. But a 61.5%, you did have some cash in there that held you back, but for the most part, since that period, you can see you've had strong outperformance since repositioning this portfolio. You've fiscal year to date, you're beating the benchmark by over 100 basis points. On non-U.S. equity, as Matthias said, not quite as strong as U.S. Developed markets were positive, emerging markets were not, but you beat your benchmark for the month. And even though not as strong as the U.S., your fiscal year-to-date return for your combined non-U.S. portfolio was just over 29.5%. So incredible numbers. If we look at your fixed income exposure, Matthias mentioned that interest rates have gone up, so you can see that reflected in the returns for your core fixed income portfolio, down almost 1% for the month. Fiscal year to date, still slightly negative, down 0.24. As Matthias mentioned, last year was strong for fixed income markets. There's a number to the right-hand side. It's just a reminder that your core fixed income return for the year of 2020 was up over 8.5%. So changing environment, interest rates going up, not good for your core fixed income portfolio. And as Matthias also mentioned, though, having the diversification of having a non-core fixed income allocation is beneficial from a diversification standpoint, also from a yield standpoint. And you can see, even though core fixed income is negative, your non-core portfolio has had positive returns fiscal year to date, up over 12%. Going to the next page, again, this is the preliminary report. So I would say with the private investments, we're showing for private equity, not the state fund, but for private equity, that portfolio, and this is lagged a quarter, was up, and we had a good December. So up 10.62, beating benchmarks, and fiscal year to date over 29%. We do not have Townsend numbers. Your real return portfolio, again, I would say these numbers could change, but outperformance against your benchmark there as well. Just your financial real return composites, it's only just over 1% of your portfolio, but these are the MLPs, and which has struggled really since you've been invested them up and down. But for the year, those MLPs, small allocation, have returned just under 58.5%. So preliminary numbers, strong numbers, and Matthias and I'll take any questions that you might have. We'll have certainly more detail with the March report when we meet with you next month. Thank you. Oh, okay. Questions from committee?
This is Lee. I got one question again. We used to get, and we still get, but on an infrequent basis, the capital markets review chart that's kind of the colored blocking chart. Is there a reason that we don't get that consistently, or is it possible we could get it more frequently.
We put it in the quarterly report. Matthias, do we update that on a monthly basis?
Yeah, we can certainly, absolutely, yeah, we can include that. I also made a note to move the capital markets page up to the front in response to Madam Chair's comment. It's tucked in the back because typically it's a short review, but we have been spending more time on capital markets, so I think it will make sense to add both of those and move them up.
And Lee, you're talking about the chart that we call a quilt chart that shows the best and worst performers each by year.
Correct. It's an easy visual.
Yeah. Okay. We'll start including that.
Thank you.
Thank you, Member Rawson. Any other questions for RBK?
Thank you.
All right. I'm not sure if Member Lavender has joined us yet. So is there a member of the investment committee on that would like to do the investment committee report?
This is Mike Messina.
You, Member Messina?
Yes, thank you. Well, we had, I thought, a very productive meeting. Of course, among other things, we reviewed a number of proposed investments, and we have, in each case, recommended that the investment committee approve each of those. And that was pretty much it.
All right. Then with that, we will go to our investment group. Thank you, Member Messina. We'll start with agenda item 3B, Iconic Strategic Partners 6. And I'm going to turn it over to Mr. Lee from the SIC, and then you can call on folks from there. Is Mr. Lee on with us?
David, are you on the line?
Hi, Madam
Commissioner,
I got disconnected. Is it my turn?
It is your turn, David.
Sorry about that.
We're on Iconic.
Okay. So I'm joined on the call. This is David Lee. I'm joined on the call by Chris Cassidy, also on the staff, Richard Pugmire and Amy Ridge of Mercer, and also Kevin Foster, who is a managing director of Iconic Capital. All these materials start on Diligent page 64, and I'll just make some brief comments, and then we'll do the usual process and turn it over to Mercer, and then the manager for final comments, and we'll open it up to questions. In terms of Iconic Capital, they are a privately held financial advisory and investment firm with $54 billion in assets under management in 4 areas: a multifamily office, Iconic Growth, digital infrastructure, and real estate. There's roughly 300 employees in the firm, and it's headquartered in San Francisco with offices in New York, London, Singapore, and Palo Alto. The Iconic Growth platform has almost 50 employees, and they're scattered amongst investments, portfolio engagement, and some back office accounting, finance, and valuation professionals. The Growth also has an 8-person technical advisory board. These are current and former executives from companies like Airbnb, Dropbox, Cisco, Slack, Lyft, Facebook, and Pluralsight, and they're very, very helpful. The fund strategy will focus on investments in technology and technology-related sectors, and specifically focusing on enterprise software, financial technology, or fintech, and consumer-oriented technology. Geographically, the growth strategy is global, but most of the companies in their target industries tend to be in North America or Europe. Iconic Strategic Partners Fund 6 has a target of 15 to 21 core positions in the fund, and the target size for this fund is $3.75 billion. For perspective, Fund 5 was $2.6 billion, and Fund 4 was $1.8 billion.
and we are expecting an above-average general partner commitment to these funds. The Iconic Growth Funds have been in high demand and very, very difficult to access. The firm has assembled an extensive and deep network, which it utilizes to get in front of high-demand companies and to add value post-investment through customer and strategic introductions. Also, historic loss ratios have remained very low and very strong company performance. And by that, I'm talking in excess of a 5 times multiple is present in nearly every fund. The fund performance for the first 5 funds has been remarkable, with almost all funds ranking in the first quartile and even top decile compared to the Burgess North American Venture Capital universe. Funds 4 and 5 are off to a fast start, but they are very recent vintages. And the distributions to paid-in capital for the first 3 funds are also mainly first quartile. Staff and consultants are recommending a commitment of up to $40 million in Iconic Strategic Partner 6, as we believe Iconic would be an excellent long-term partner. And this would be the first commitment to Iconic in the private equity portfolio, and the second commitment across the portfolio, as about 11 months ago, there was an investment made in a data center infrastructure fund by the Real Assets team. And with that, I will turn it over to Richard Pugmire of Mercer.
Thanks, David. As David mentioned, this is a new relationship in the national program. And as you know, we have a high bar for new relationships. We've only made commitments to 27 managers since 2011, so we've been quite disciplined. And we think the characteristics of this fund is strong for inclusion in the national program. As David mentioned, this is a highly sought after fund and is expected to be significantly oversubscribed, but we feel over time that we can grow this into a meaningful relationship. I'll highlight some of the conclusions of our analysis. As you can see from the performance numbers, the track record is very strong. Funds 2 through 5 have been in the top quartile, and some funds are actually in the top 5% of venture and growth funds. They've been able to generate this performance through identifying strong companies. And while a lot of the performance is unrealized, they have had several favorable realizations to date and a low loss ratio. When you look at the platform, Iconic has built out an experienced senior investment team who has relevant previous experience to the investment strategy. They've really complemented the investment team with a lot of resources that can add value to portfolio companies. For example, they have an analytics team that can assist with market research for both the investment team and portfolio company management teams. Because they target later stage companies, they're able to do a lot of analytical work during the due diligence process and have an impressive research process. For portfolio companies, they can assist with things like compensation strategy or trend analysis. The key part of the strategy is the network that Iconic has built across its platform. The firm has connections to industry executives and professionals that help across the investment process. So these individuals can help Iconic get introduced to a company that may be hard to access, to make a potential investment down the road, or post-investment can assist companies with things like customer introductions or introduce them to individuals or larger corporations that could be potential strategic partners to the companies. Our report also highlighted several areas of consideration. As you see a lot with firms that have been successful, they have been growing their fund size. While this is common to see with successful investment firms, there could be concerns around execution and capacity. On the execution side, we're seeing that they continue to build the Iconic platform and have an impressive amount of resources to manage the strategy. On the capacity side, they have been able to successfully realize companies, which frees up capacity for senior professionals. They're also continuing to develop their mid-level and junior professionals, which increases capacity over time. When considering Iconic's performance as well, they haven't invested across a full economic cycle and have been investing over a period that has been very favorable to growth technology companies. But when looking at this risk, we do note that the individual team members have experienced through multiple economic cycles at other firms. And also Iconic's strategy has several value add levers that they can pull to help portfolio companies if markets were to flatten or decline. Finally, the fund does have premium terms, which is not unexpected given its performance history and the high quality firm that it is. We do focus on net of fees performance in the report, as we want funds that generate strong performance over funds that generate mediocre performance but may have a better term structure. Also, the team is expected to have a sizable commitment to the fund, larger than other funds in the market, which helps improve alignment with investors. And so we recommend an up to $40 million commitment to Iconic Strategic Partners 6. I'd like to turn over the presentation to Kevin Foster, who's Managing Director at Iconic based in San Francisco. He's been at Iconic since the firm was founded. And after Kevin's presentation, we're happy to answer any questions you may have.
Thank you, Richard. Thank you, David. Appreciate the introduction. I'll keep my comments rather succinct, given how exceptional the job you did introducing Iconic and the growth equity platform. So thank you for that. Thank you to the council for inviting us today, and we appreciate the time in front of the group. As David mentioned, we look forward to building our partnership further with the council, given our existing relationship via our digital infrastructure platform called IPI Partners. As it relates to growth equity, first, I want to say thank you to David, Chris, Richard, and his team at Mercer. They've been exceptional partners throughout this process. It's clear you have a world-class organization across the council, you have different asset groups, and it serves as a fantastic long-term foundation from our perspective to build a collaborative partnership between our groups and find ways to continue to work together and help one another. As it relates to Iconic, just some brief points from an introduction perspective on Iconic. As David mentioned, we were founded about 10 years ago in 2011. We have 300 professionals and over about $60 billion of assets. We have several businesses that work collaboratively together, but with dedicated teams and resources. Our direct investment teams include digital infrastructure, as I mentioned, where we invest in data centers and other technology-driven infrastructure assets. Real estate, where we seek to redefine accommodations in the world's largest cities through vertically integrated technology, ownership, and asset management. And growth equity, which we're speaking about today, where we pursue partnerships with exceptional entrepreneurs to affect global impact and change. Within growth equity, what we ultimately look to identify are leading companies that are going to be market leaders and or category definers, led by product-oriented founders. We look for category leadership in a large growing market, exceptional growth underpinned by strong unit economics, fundamentally differentiated products, outstanding leadership teams, and as a growth equity investor, these are businesses with established revenue and products, allowing us to create a strong risk reward from our perspective for our partners. From a geographic perspective, given our focus on enterprise and fintech, we are primarily active in North America and Europe by default. With our deep expertise in technology and identifying fundamental market drivers as well as secular shifts, we're focused on the massive and rapid shift of applications and infrastructure to the cloud. This has been happening over the last decade and continues to do so. We're focused on digital transformation, driving productivity, and the global connectivity and access that we see increasing by the day. Throughout the last 10 years within Iconic Strategic Partners, our focus has mainly been on the enterprise software and fintech markets. The enterprise market continues to evolve substantially, creating opportunity for new companies to form and grow. Cloud growth has consistently surpassed tech projections, and we believe that the disruption potential is still enormous. And similarly, fintech continues to evolve in a cloud-centric world. As we pivot over to Iconic Strategic Partners 6, we are proud to have a consistent senior team since the early days of the platform and a strong level of diversity across the team at this point, which is almost 50 people. We have almost 80 portfolio companies, and from a quantitative perspective, we've had strong success with 16 IPOs, 5 M&A exits, over $20 billion of value appreciation, and top quartile or higher performance across our first 4 funds. We also are proud of how we support our portfolio companies on an ongoing basis, as David and Richard mentioned, between analytics and insights, leadership advisory, and technical advisory. All 3 of these motions leverage our extensive network, our deep expertise, and our proprietary data and resources that we built here at the firm. With these remarks, hopefully it gives you a good sense of our platform and strengths as we transition into Iconic Strategic Partners 6, and we look forward to having the council as a partner as we continue to identify and invest in strong trends within the world of technology. Thank you again to David, Chris, Richard, and the Mercer team and their efforts leading up to this call. I'd be happy to open up to any questions.
I didn't catch your name. Is it Foster?
Yes, Kevin Foster.
Mr. Foster, could you just speak briefly to the sort of capacity concerns
rate of growth concerns that were mentioned by Mercer?
Sure, absolutely. So this is something that we've been focused on for many years. We've built our team over the last 10 years to almost 50 people. And at this stage, as we're adding portfolio companies, we're also have portfolio companies which are entering the public domain, that are being sold, and are rolling off as portfolio companies. So as such, we feel like we are well staffed across the entire pyramid of most senior general partners down through our associates and analysts, and have the right team for our strategy, for the market, and how we're going to play this market on a go-forward basis. So we feel quite confident that we have the right foundation, right team for Iconic Strategic Partners 6.
Thank you. We're going to go to council questions for either our staff, Mercer, or the representatives from Iconic. Any questions from council?
Madam Chair, this is John Bingaman.
Yes, Member Bingaman.
I'd just like to say, for the record, I'm going to recuse myself from this discussion and this vote. I actually have a personal investment that could create a conflict here.
Thank you for letting us know, Member Bingaman. Any further questions from council on this?
Oh, this is Lee. I got one.
Yes, Member Rawson.
For the representative from Iconic. With regard to the ESG issues, it's noted that you have passed on several opportunities because of concerns with the ESG. Could you give me an idea as to what ESG concerns would cause you not to invest in a company? At what point did they reach that level?
Sure. Great question. It's been front of mind for us since we started our platform 10 years ago. There are a number of different factors that could preclude us from investing, such as the focus area of the underlying company, such as the management team and the track record and or reputation of those management teams, and any sort of other concerns that we may have that the company may have a negative impact on a variety of environmental or societal issues based upon the way that they operate. So there's a number of factors that come into play as it relates to ESG, and it's a very important topic for us and one that's been important throughout our entire history.
That's pretty broad non-answer. But what are the specific areas that would raise more concern for you? Because it is a big social and political and environmental. There are a lot of issues out there, and evidently some raise greater concern than others to each of us. But in terms of investing in your with firms that you might purchase, which of those have the higher priority, I guess? In other words, where do they reach the level? Which ones reach a level that you say, okay, absolutely, we don't want to go this direction?
Sure. Because of where we focus in the world of software and enterprise and fintech and consumer applications, some of the issues around ESG just are less relevant to where we play. That you may see other managers and other focus areas where we're the ones that raise to the highest levels of concern are really the types of companies and the types of businesses that they're creating. Are they predatory businesses? Are they playing in spaces that have reputational issues that are in gray areas that might not be regulated? Those are the types of pockets that are most likely to hit our flags, given the space that we play.
Thanks, Madam Chair.
Thank you, Member Rawson. Further questions? Okay. So with that, we will move to a vote, or a motion. And I don't know if Member Messina would like to take this on for the investment committee.
I'd be glad to make the motion. Unfortunately, I don't have the precise language because there's no script available to me. The motion is to approve this investment in Iconic, subject to the laws and rules applicable. I don't know if that's sufficient enough.
So do you have your packet? It's actually the page that
No, I'm having a problem with my internet.
Okay.
And I haven't been able to get to it yet. I'm trying while we're talking. I'm sorry.
Okay, so what is a proper motion, Steve? Is that sufficient?
Commissioner, if someone else would kindly read the motion, that would be helpful. Vince, do you want to read it for us, please?
So Vince can't make a motion, though.
Madam Chair?
Oh, yes.
This is Member Romero. I'm happy to read it.
Excellent. Thank you.
Okay. So based on recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that will approve commitment of up to $40 million to Iconic Strategic Partners, SIC LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you so much, Member Romero. So we're going to have a motion from Member Messina, a second from Member Romero, and is there any discussion on that motion? And we do have one member that will be abstaining from this vote. So with that, we're going to have Carrie call the roll on a motion to approve $40 million to Iconic.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Lee Rothman.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Kathy Allen.
Yes.
And I've noted Mr. Bingham's recusal. And let me just check, Mr. Tayet, have you joined the call? Right, I guess not. But the vote does pass 8-0.
8 in favor, 1 abstention, and 0 against. Okay, thank you so much, Carrie. Thank you. Yes.
Madam Chairman?
Yes.
I was a little surprised that some of my Senate colleagues that are on the investment council didn't use the old standby motion that they used to make, and some people used to make in the Senate. Was it, Madam President, I move all appropriate motions be made.
Member Jennings, we will keep that in mind. Unfortunately, because we are not in person and live, we, in the best interest of the public that are listening in, I don't think that's going to quite do it. But I do appreciate we've got 3 former New Mexico State Senate members on this council, and so I'm sure that will come up at some other time. Thank you, Member Jennings. All right, I was going to thank the representatives from Iconic for being on with us to answer questions from our members. And with that, I'm going to move on to the next investment recommendation. It's agenda item 3C, Carlisle Realty Partners 9. Turn it over to Mr. Chapman.
Thank you, Madam Chair. And I just want to do a sound check. Don't trust my earbuds here.
We hear you.
Great. Okay, well, thank you and good morning. This is Paul Chapman, Director of Real Estate and Real Return. And on the call with me today, we have Clay Camper and Nino Carpenito from staff, as well as Seth Marcus and Jack Cove from Townsend. And from Carlisle, you'll hear from Roman Boss, Chip Lipman, and John Rogg. Seth will be presenting the Townsend underwriting of a proposed commitment before turning over to the Carlisle team. Staff and Townsend recommend a commitment to Carlisle Realty Partners 9 in the amount of up to $100 million. Carlisle seeks to raise a $6 billion fund for Carlisle Realty Partners 9, a closed-end to the mid-teens using 60% leverage. New Mexico State Investment Council has a significant relationship with Carlisle. In our real estate portfolio, we have commitments to Carlisle Realty Partners 9, which is the predecessor fund, in the amount of $100 million, and to Carlisle Property Investors Core Plus also in the amount of $100 million. And that fund has generated a 12% net IRR at the fund level, although we are a new investor to the fund. Excuse me. In our real return portfolio, we have commitments to Carlisle Power Partners Fund 2, which is a $100 million commitment, and to Carlisle International Energy Partners 2 in the amount of $105 million. That's $65 million to the main fund and up to $40 million available for co-invest. I'll also note that Carlisle owns a stake in NGP, one of our energy managers. And though not my area of responsibility, our private equity team has a very small exposure. I think it's in the range of a couple $1 million to some legacy Carlisle private equity funds. In aggregate, these commitments don't breach our manager concentration limits as set forth in the respective real estate and real return policy investment statements. I'll remind the investment committee that we've had strong performance in our real estate portfolio, outperforming our benchmark in all relevant time periods other than the 1 year. And I would point the committee to the table on page 171 of Diligent, which is page 5 of the Townsend Covenantal. And that table shows our portfolio diversification. And if you look at that, you can see that we are underweighted to retail relative to the benchmark. We're overweighted to industrial. We're underweighted to office. And we're projected to be overweighted to multifamily. And this is all very intentional, and it's really been a key driver of our strong performance. We're also over allocated to a sector that is called Other. And Other is really, it's a catch-all for such things as life science, biomedical, student housing, senior housing, single-family rentals, storage, and manufactured home communities. In our upcoming real estate structure study, you'll see that we intend to expand our investments into this other category, and a commitment to Carlisle Realty Partners 9 is expected to move us in that direction. In fact, 27% of Carlisle Realty Partners 8, the predecessor fund, is invested in other property sectors. Also point out that 86% of that fund is invested in what they call demographically driven sectors. The strategy of investing in demographically and technology-driven sectors instead of GDP-driven sectors gives the fund significant tailwinds in terms of rent growth and appreciation. The recommended investment to Carlisle Realty Partners 9 is within compliance of the investment policy statement parameters. And now Seth is going to discuss the Townsend underwriting of the fund.
Thanks, Paul. So I'll start. I'll try my best not to repeat any of Paul's summary, but as Paul highlighted, we're recommending a $100 million commitment to the fund today, and it is a follow-on commitment. This would be the 5th non-core commitment for the 2021 calendar year, which will put us over our original planned investment pacing model by approximately $150 million. However, this is in line with what our planned overcommitment was discussed earlier this year, of approximately $400 million. Our total commitment for the year would be $425 after this commitment. The overcommitment here is really the result of attractive opportunities given the volatility we've seen in the market over the last year, as well as re-up timing, so follow-on commitment timing to existing strong managers like Carlisle and their strategies. As we've mentioned in the past, we need to be cognizant of vintage year diversification and maintaining that diversification. And lastly, given the real estate target allocation is a range of 10 to 15%, the current projections based on our commitments and overcommitment are not projected to cause any compliance issues. The last point I'll make on the commitment size is at the $100 million level, we are achieving a 30 basis point fee discount from commitments that are under $100 million. And we are targeting to participate in the first close, which occurs on June 1st, for an additional 15 basis points discount. So we're looking for some discounts based on our commitment size and timing. Paul described the fund well, but I'll highlight that in our materials, this is a U.S. only opportunistic fund targeting $6 billion of total capital, of total equity. And based on pipeline transactions and underwriting memos, the fund anticipates to generate those mid-teen returns net over the 10-year life. They anticipate achieving these returns and have done so historically by really focusing on established and accelerating trends driven by this U.S. demographic and technology shifts that Paul mentions. Carlyle will seek to overweight property types in the multifamily, age-restricted apartments, single-family rentals, and industrial, and then they'll underweight GDP-linked properties. So to Paul's point on underweighting of our portfolio, but office, retail, and hotels will be strategic underweights for the fund. The fund will create value through ground-up development and renovation and/or redevelopment using joint venture operating partners. And the fund will target deals within the 30 largest MSAs. So it really intended to exit those assets to long-term core buyers. Carlyle's focus is on mid-market properties, so about $50 million in gross transaction volume. And when you think about the size of the fund relative to the size of the deals, it adds up to quite a bit of assets. So as you can see in our report, it's highlighted on page 174 of Diligent, page 1 of our underwriting memo. They've averaged close to 200 assets, individual properties in each of the prior funds, and that'll likely be the size or the number of properties in this fund as well. And this really leads into what we believe is the top comparative advantages for Carlyle. So the sponsor is a leading global alternative asset manager that has been in existence since the late 80s, has over $230 billion in assets under management across the platform. And the real estate platform, the team, the strategy has remained consistent in the U.S. throughout the fund series. The team investing in the fund is responsible for the majority of Carlyle's U.S. track record, and the senior professionals average 16 years with Carlyle and 25 years of industry experience. The full U.S. real estate team is staffed with over 100 professionals. So since the late 90s, Carlyle has made over 800 opportunistic investments, over $16 billion in investor equity, and the team, through these investments, has established network relationships and is well known in the industry. So lastly, Carlyle has a well-established investment process that is applied consistently across their funds and these investments. There's a number of other comparative advantages listed here. I won't go through these in detail, but we mentioned here the alignment, lower leveraged approach, consistent track record, and complementary strategy within the real estate portfolio. But under the potential issues and concerns, we believe these are well mitigated, but one that might stand out or I think necessitates a brief comment is the anticipated development exposure in the fund. So in order to generate the target returns we've discussed, development will be a significant component of the strategy. So in prior funds, development is consistent of about 90% in Fund 8, 70% in Fund 7, and likely similar numbers here in Fund 9. To the extent possible, Carlyle's strategy is de-risked within the range of ways that managers can really approach development. So first off, the fund will largely consist of apartments and industrial or warehouse properties, which really have a relatively short and more predictable construction timelines, and where acquisition pricing has become really high, resulting in low cap rates. The construction projects within these properties are simple on a relative basis to sort of large, multi-phased, urban mixed-use developments and or office developments. Additionally, Carlyle does not take on entitlement risk. So Carlyle, utilizing the certain structures and practices, also considers standard and best practices for development and requires GMP contracts, which are guaranteed maximum projects or costs. They are borrowing at levels that do not require lender recourse, so the portfolio is not at risk for leverage. And it also requires JV partners to take on lender repayment and completion guarantees. So they offload some of the risk onto those operating partners. Lastly, the fund's high level of diversification. I mentioned a lot of different properties. So any single development project that will have an outsized negative effect, will not have an outsized negative effect on the fund. So in the event a problem asset occurs, Carlyle maintains a high level of asset management staffing and in-house development expertise to provide really hands-on oversight and resolve any problems that may occur within their framework. I'll stop here. I know the Carlyle team is anxious to present as well, so I'll wrap up and just remind the members that this investment has been approved by Townsend's Investment Committee on a standalone basis as well as on behalf of New Mexico's real estate portfolio. So with that said, I'll hand it over to the Carlyle team.
thanks so much for those comments. My name's Chip Lippman. I'm a managing director with our U.S. real estate team at Carlisle. And just a brief introduction to myself. I've been at Carlisle since 1998 when Rob Stuckey and I came to the firm, beginning with Fund 1. And what was mentioned earlier was important. We think our team has among the strongest continuity in the business, where team's been at Carlisle for quite a long time, has, I'd like to say, delivered consistent performance across a variety of cycles, and is now approaching across our funds nearly 1,000 investments in our time at Carlisle. We really have enjoyed the relationship and the support of the council, and with your involvement of Carlisle Realty Partners 8 and our Core Plus vehicle. We enjoyed that and appreciate your consideration here. Enjoyed working with Paul, Clay, and Neil as we have gone through due diligence. As you think about our team, we consider ourselves to be operators. We want to be in situations where, with respect to the fundamentals, we see the local supply and demand being very much in our favor, and are looking to find situations where we have deep and growing pools of demand, where that should translate to asset property cash flows growing strongly in our hold periods. We think a lot about fund construction, and it's already been touched on by everyone, but some tenets of our practice include high levels of diversification, avoidance of concentration risk, single silo non-recourse debt structures, and debt levels that have run at the 50 to 55% range across our vehicles. With Fund 8, we're off to a very good start, we believe. We have about 40 realizations that have, on balance, generated an early return of equity at about a 1.9 multiple. Most of those have been the short duration developments that were touched on. And we expect to be fully deployed with that fund over the course of the summer, at which time we'll begin investing this fund, Fund 9. So our intention is to continue with these themes, continue to find individual situations where there is value, and we do have that acceleration of predictable demand. And lastly, with respect to the sectors that we're focused on, it's important to note that in your exposure with us, we have absolutely no exposure in Fund 8 or our Core Plus vehicle with respect to office, hotel, or retail. We have focused on demographic-based themes where we have really 4 criteria: lacking cyclicality and lacking correlation with GDP, where we have high operating cash flow margins. We like to invest in these sectors that offer a longer length of stay among our tenants, causing less frictional vacancy and hopefully providing the landlord with, on balance, more pricing power. And lastly, we've been, I would say, firmly considerate of the impact of technology. And we have, on top of avoiding office, hotel, and retail for maybe where today obvious reasons, we also have considered that they're facing headwinds with respect to technology. And so that's been another factor in our sector selection. But with that, I'll hand it over for questions, and again, appreciate the relationship and your consideration of our next fund.
Thank you, Mr. Lippman. So we are going to go to council questions now for either Paul and his team, I apologize, Townsend folks, or our representatives on the line from Carlisle. Questions from council?
Well, this is Lee. I got a question.
Yes, Member Rossman.
Yeah, Mr. Lippman, I'm trying to wrestle with this concept on the single-family rental housing, which is noted, and trying to figure out what your perspective is on that percentage of the market growing as we begin to hear about more and more, companies going into, the single-family rentals. What your perspective is of that on this fund, what you perceive a hold period for, and how that meshes with, trying to average a roughly $50 million investment. Because we're not going to be investing too many $50 million houses. But how does that functionally work if you go to, that's a lot of individual transactions, and that doesn't seem to fit into my perspective. So maybe you could just
speak a little bit to that?
Oh, great. No, those are great questions. And so when we talk about single-family rental, as we think about it, it's really I would say an extension of our multifamily practice. And by that, I mean, we're focused on projects where we can have collections of somewhere in the neighborhood of 100 to maybe 120 homes. And if you think about it, just one example is maybe where a home builder might be delivering a section of, say, a subdivision and carve off a piece of that subdivision to be rented in bulk in one collection of the houses around it, like maybe a corner of the broader site. And so as we think about that, I almost think about that being operated in a fashion where it's multifamily in maybe a horizontal, separately built neighborhood. And there is growing interest in the sector, to be sure. As we look at our activities to date in Fund 8, single-family rental has been about 6% of our portfolio. We do expect it to grow to something that is in the double digits in Fund 9 as a proportion of the total fund. The thought behind the demand is worth noting. With millennials, we have been focused on multifamily as they were growing strongly into, say, their 25 to 34-year-old age range. As we look ahead and as the millennials now move into their mid-30s, the thesis is that they're moving into their next stage of life where they need more space, have to consider things like schools and forming as they form a young family. And there are barriers to them buying homes, or even, I would say there's also a predilection toward renting that wasn't present maybe 15 years ago. As we look at that population, the 35 to 44-year-old age cohort is going to be growing at about 1.8% per year over the next roughly decade. And so we very much like the demand trends when you consider that growth and the increased propensity to rent. That does make it more of an institutional market. I also would just lastly say that as we have these collections of assets, it does potentially lend itself toward we'd say a volume premium, where you sell multiple sites to institutional buyers that see these demographics and like the strong cash flow traits. It is I would say, a market that is seeing growing interest and greater level of institutionalization, if there is such a word. But that's the basic framework about how we're thinking about investing into it.
So you would be thinking that you're going to be targeting neighborhoods of 100 to 150 homes, and then you're going to be negotiating bulk transactions with national builders in most cases. Is that the right assumption?
Yes, a variety of builders, and there might be a few cases where along the lines of short duration development where we might work with a partner that wants to take down that site where it's again, smaller, offers short duration, where we get involved in actually constructing those homes and getting to the right value in that process as well.
So what do you see in terms of the duration on an individual?
Oh, I'm sorry. Yeah, you asked it up front. I should have answered that quite. Sorry. We are underwriting these to be, I would say on balance, about a 4-year hold, where we achieve a yield on cost that offers us quite a spread compared to what we can sell it for when it's stabilized and finished. Maybe order of magnitude, something like 150 to 200 basis points of spread between our achieved yield and where we might sell these. Spread between maybe something like 6.5 and 4.5 in terms of the spread we would achieve between acquisition or development and sale. And I would say that as we're seeing in Fund 8, while we underwrite a longer hold period, our intent would be to try to get that profit level earlier as capital is coming into this sector.
And you perceive that you sell these projects then as a single unit to another large investor, not to individual future home buyers. That's right?
Oh, absolutely. I'm sorry. I should have mentioned that as well. Yes, we would sell them in bulk to another institution who wants that exposure. And now a downside, something that we do underwrite that's, I guess, worth noting is that in a scenario where if the market just went completely away, a check, I would say, on our underwriting is looking at the retail value of the homes and how we would end up, obviously, if we sold them retail, but the much better execution and higher returns are available to us selling in bulk, to be sure.
All right. Thank you very much.
Thank you.
Thank you, Member Rawson. Further questions from council? Yes. Do we have a motion?
Madam Chair, I could get assistance. This is Member Messina.
Yes, Member Messina.
If I could get assistance on the motion, because I'm still having internet issues, I do want to make a motion to approve this, but I need help with the specific language, please.
Madam Chair, I'm happy to do that.
Great, thank you. Member Romero.
Based on the recommendation of the Council Investment Committee, Real Estate Advisor Townsend, SIC, staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve commitment of up to $100 million to Carlisle Realty Partners 9 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you. So we'll do a motion by Member Messina, a second by Member Romero. Any discussion on that motion? So with that, we'll have Carrie call the roll on a motion to approve an investment to Carlisle Realty Partners 9.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
I'm sorry, yes.
Thank you. Lee Rothman.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Kathy Allen.
Yes.
And John Bingaman.
Yes.
It's an 8-0 unanimous decision.
Thank you, Carrie, and thanks to the folks on the line with us from Carlisle.
Thank you, Madam Chair, and thanks to the members of the committee.
Thank you, Mr. Chapman. Next, we'll go to our first two fixed income recommendations. So, agenda item 3B, PIMCO Bravo 4. I'll turn it over to SIC staff, and then you can call on folks that you have there after that.
Good morning, Madam Chair. This is Keith Zabel. I'm the new Director of Fixed Income at New Mexico SIC. We'll have a pretty full agenda for everyone this morning. We'll lead off with two recommendations of $100 million allocations for new funds that would go into the distressed and other bucket within private credit that we view as moderately underweighted. We'll follow that up with a recommendation for a full liquidation of a third portfolio. Joining me today will be Jennifer Wildman, who will quarterback the Axia team that's supporting today's presentations. With that bit of housekeeping out of the way, we'll jump straight into PIMCO Bravo 4. Representing PIMCO today on the call with us will be Alantika Medina, Michael Chandra, and Brant Gresham. Staff is recommending a $100 million commitment to the PIMCO Bravo Fund 4. This would be a re-up of an existing commitment in the preceding PIMCO Bravo 3 fund. Targeted returns for the special situation strategy are on the order of 14% net. Managing over $2.2 trillion, PIMCO is one of the world's largest investment management firms. It was founded by Bill Gross in 1971 and is now owned by the German insurance giant Allianz. PIMCO's scale has enabled it to build a platform with multi-asset, multi-market, full capital structure capabilities and a global reach that few organizations can match. Staff believes that the platform will allow the fund to capture a complexity premium by enabling it to address difficult to underwrite special situations and to provide capital solutions to counterparties around the world, primarily in the United States and Europe. The scope and the breadth of the platform will support a broad mandate and give the GP great flexibility to allocate capital to the most compelling opportunities that present in the wake of the COVID-19 pandemic. We agree with the GP's assessment that the lingering effects of the recession are likely to provide a multi-year window of opportunity during the fund's investment period.
The focus of the portfolio will be on a number of different categories: commercial real estate, residential credit, specialty finance, and structured credit. The fund's predecessor, Bravo 3, performance will fail to meet management expectations, principally due to the impact of COVID-19 on some asset valuations. Still, the expectations are that the portfolio will generate a 9.4% IRR, sufficient to beat the policy benchmark for that fund. Based on the breadth and depth of our relationship, SIC's relationship with PIMCO, we believe that we've been able to access attractive fees for the investment, and we believe that the timing is particularly auspicious for this strategy, and we would recommend, again, a $100 million allocation to PIMCO Bravo 4. At this point, I will turn the floor over to Jen Wildman, who will lead Axia's discussion of their underwriting.
Thank you, Keith, and good morning to the council members. I thought I would just quickly touch on pacing to provide the council with a sense of where we are for 2021. Last year, we modeled that New Mexico State Investment Council should allocate approximately $400 million in this year to keep the non-core fixed income portfolio on track with targeted growth. We've recently redeemed from a legacy managed account and are bringing later on in the agenda a recommendation to redeem from another, which is Angela Gordon SMA, to be considered today. So we really do have some additional room to go over that $400 million this year. Just wanted to highlight that before getting into these two recommendations. And as Keith mentioned, we're bringing PIMCO Bravo 4 today. PIMCO is a longstanding relationship for New Mexico SIC. This is the fourth vintage of the fund, and you've participated in vintages 2 and 3. And total NAV, or net asset value invested, is presently at $145 million, just given the pace of capital being called. Fund 2 is now in its harvest period, while Fund 3 is closer to the end of its investment period. PIMCO Bravo is a core position in this portfolio. The flexible approach employed by PIMCO in this particular fund really allows them to shift the allocations in accordance with the opportunity set. And the recommendation today is meant to keep the total Bravo allocation at that core size within the portfolio and, of course, continue the relationship with PIMCO Bravo. This addition will bring the total committed capital in non-core fixed income to approximately $4.6 billion. This fund falls within the distressed allocation, and the additional $100 million commitment will bring that bucket to approximately 25% of the overall portfolio. This is really on the low end of the target range of 20 to 40%. As Keith mentioned, New Mexico will receive significant discounts on this fund. It's really due to, the breadth of the relationship and the longstanding history, and we're excited for this. I'll pass the discussion to Aaron Nessel to discuss the due diligence findings on our end in more detail.
Hi, everyone. Nice to speak with you all again. As Jen mentioned, we conducted a full investment and operational review of PIMCO Bravo 4, the fourth vintage of PIMCO's opportunistic special situations strategy. We know PIMCO quite well and previously completed diligence on Bravo 3 as well as a number of other PIMCO funds. And I'll just give you a brief overview of the fund and our findings before passing it off to the PIMCO team. PIMCO originally launched the Bravo series in 2011, which initially looks to take advantage of non-performing loan sales and bank recapitalization opportunities after the global financial crisis. The strategy has evolved over time with an initial focus on liquid markets, primarily commercial mortgage-backed securities and residential mortgage-backed securities, but has since shifted its focus toward private markets. And that shift has really been apparent in Bravo 3 and is expected to be consistent in Bravo 4. The fund is managed by a large team of 98 investment professionals. Though they are not fully dedicated to the fund, they do spend much of their time on the fund, and they are divided by the asset classes that the fund will focus on, including commercial real estate, residential credit, structured credit, and specialty finance. The investment committee is headed by Dan Iveson, the CIO of PIMCO, as well as John Murray, who covers commercial real estate, and Jason Steiner, who heads residential credit, along with other individuals who represent the asset classes that Bravo will invest in. As previously mentioned, the fund has a very flexible mandate to invest in a wide range of assets across the capital structure, public and private markets, and geographies. PIMCO at this point expects to allocate about 40 to 50% of the fund to commercial real estate, 10 to 20% to residential credit, 20 to 40% to specialty finance, and 0 to 20% to structured credit. The fund is likely to be about half or 60% to the U.S., allocated to the U.S., 40 to 50% to Europe, and a small allocation to other regions across the world. However, this is a truly opportunistic fund, and there's no officially set risk limits. The primary terms are as follows. They're going to be targeting a $3 to $4 billion capital raise with the first close in the middle of May. The investment period is 3 years. The harvest period is 4 years. Standard fees are 1.5% on invested capital and 20% carry over an 8% hurdle. So as Jen mentioned, New Mexico will be able to take advantage of some attractive discounts for first close investors, repeat investors, and investors of size. In terms of what we like about the fund, the key merit here, in our opinion, is the scale, the reputation, and the resources of the PIMCO platform. PIMCO has a large and experienced team that has worked through multiple market cycles. They developed a strong investment process, sourcing capabilities, and financing relationships across the industry. Based on our view of the market, there are a few groups that have been able to develop capabilities across a wide range of asset classes like PIMCO has. As Keith mentioned, we also think the opportunity set is quite attractive and likely favors a broad strategy that can move across asset classes, liquid and illiquid markets, and across the capital structure. We especially like PIMCO's approach in residential credit and commercial real estate, and think they'll continue to find interesting opportunities here. And lastly, we do think that the fee discounts are quite attractive for New Mexico's position. We would note that Bravo 2 and Bravo 3 have somewhat underperformed expectations as COVID has impacted the portfolios. However, we do believe the forward-looking opportunity set is attractive, and we believe PIMCO is well equipped to take advantage. I hope this was a helpful overview, and I will now pass it off to the PIMCO team.
Thank you, Aaron, Jennifer, Keith, Madam Chair, council members. This is Brant Gresham from PIMCO. It's an honor and a privilege to be speaking with you. I'm part of PIMCO's institutional client-facing team, and I've been working with the council for almost 5 years at this point. First off, on behalf of my colleagues, I want to express our deep gratitude for the deep and strategic partnership between our two organizations, spanning multiple strategies in your core and non-core fixed income allocation. As a matter of fact, it's been almost exactly 10 years since the SIC's first alternative credit investment with PIMCO, which was DISCO 2, an investment that's still in the portfolio and performing quite well. Before turning the floor to my colleague Valantika to discuss Bravo 4 in a bit more detail, I did just want to take a moment to supplement some of Keith's, Jennifer, and Aaron's comments by noting that over the last decade plus, I think one of the hallmarks and demonstrated strengths for PIMCO's broader platform in the alternative credit space, which is approximately $35 billion in size at this point, has really been the creation of value in periods of economic stress or transition. As an example, in the wake of the last significant financial crisis, the PIMCO alternative credit platform, including Bravo, delivered north of 20% net IRR. And when we think about where we are today versus 2008, some of the macro and micro environment are sort of eerily similar in important ways. You had a massive economic shock, a strong at this point, but also bifurcated recovery, massive central bank intervention, and also a backdrop of political and regulatory uncertainty. One key difference is that in 2008, the dislocation and opportunity set was largely in public structured credit markets, while today, the opportunity is much more concentrated in private markets. Areas like real estate, some of the areas that Aaron mentioned, asset disposition, loan portfolio sales, and things like that. So at this point, I'll turn the floor to my colleague, to Lalantica, to talk about the taxonomy of that opportunity set, and relative to perhaps some areas of the credit markets today, why we think the Bravo franchise is ideally suited to unlock attractive potential returns available in that environment. Lalantica, I'll turn to you.
Great. Thank you so much, Brent. If you all wouldn't mind, I'll ask you to turn to page 5 of the PIMCO section, or I believe it's page 275 in the board diligence book, which includes an executive summary for the Bravo 4 strategy. Clearly, the COVID-19 pandemic is one that has had a tremendous impact on certain markets and asset classes, in particular real estate, corporate, and specialty finance markets. From this crisis, we believe that there are 3 key themes that Bravo 4 will look to capitalize on. The first being an acceleration of secular trends. The second, dislocation and distress. And the third, regulatory changes or policy uncertainty on the heels of everything that has happened. Diving into each of those themes in a little bit more detail, first, as it relates to an acceleration of secular trends, these are events and themes that were already well underway before the pandemic began, but clearly fast-tracked as a result of the event. A great example is the continued rise of online shopping, e-commerce. In turn, that has affected industrial in ways that were already anticipated, but certainly moved much more quickly. Similarly, the demise of retail. When everyone started quarantining, when the lockdowns began, retail was already facing challenges prior to that. This was just a segment that faced more pressures as a result of those events. Moving to the second theme, dislocation and distress. We think about this in the context of dislocation and distress today, which certainly over the last year, as we've seen this recovery in public markets, is something that is under the surface as opposed to readily apparent. And then dislocation and distress as we think about the years to come. Looking into those 2 segments, today you see dislocation and distress in areas like hospitality, travel, leisure. As the vaccine rollout has continued or has began and continues to take place, those areas are ones that could potentially see a lift, but nevertheless, the immediate impact from the pandemic is very present. Longer term, as we think about dislocation and distress, this comes from areas like loan maturities, as within commercial real estate in particular. As we think about the billions of dollars of commercial real estate loans that are set to mature over the next several years, the more limited supply of lenders that can provide an exit option for those loans, that creates significant opportunities for a well-resourced platform like PIMCO. The other element that I would highlight longer term is the residential market, as Brant pointed out, one that certainly has done quite well during this crisis, very different from the financial crisis where it was at the epicenter. But certainly lending gaps within that space continue to create dislocations for residential borrowers and create opportunities for non-bank private capital. Moving to the final category and final theme of regulatory change and policy uncertainty. Again, we think about this in the context of 2 areas. The first is the non-performing loan opportunity stemming from Europe, and the second is forced asset sales from capital regulated entities. As it relates to the European NPL opportunity, this is one that has been present for the last several years, one that PIMCO has participated actively in during that time period. When the pandemic first started, similar to many U.S. institutions and similar to circumstances in the U.S., many institutions in Europe were forced to put in place moratoriums, were forced to put in place different measures to ensure that they could work with borrowers as they work through this pandemic. The result is that the non-performing supply in European institutions has potential to reverse to pre-pandemic peak levels. So prior to the pandemic, at its peak back in 2010, 2011, non-performing loan supply in Europe was over 1.2 trillion. European institutions were excellent about selling these assets programmatically, especially if they figured out ways to work with buyers. And today, now as we look at what has happened, we actually see that non-performing supply reverting back to those peak levels. We are already seeing asset sales coming from those institutions. The second topic, asset sales from capital regulated entities. As banks look at their portfolios and find themselves having to reserve more and more capital to address potential losses in the future, it is incentivizing them to sell those assets as opposed to continue to hold them and continue to have to reserve larger and larger amounts of capital. And we're seeing this across a range of asset classes and sectors, including commercial real estate, residential credit, and asset-based specialty finance. This all brings us to why we think Bravo is so well positioned to capitalize on this opportunity. The areas that are most impacted are core focus areas for our opportunistic platform: real estate, commercial and residential, structured credit, asset-based specialty finance. This is the bread and butter of what our platform has originally started from. As we think about the resources, we have nearly 100 portfolio managers across public and private markets that source, underwrite, diligence, and manage these investments throughout the life cycle. And as we saw during the financial crisis, and as we've seen over the last decade, public and private markets are more and more intertwined, and the ability to access investments in one market and exit out of the other becomes even more instrumental in generating and creating value. We have a history of identifying transition points and capitalizing on dislocation. Brant pointed to our experience during the financial crisis, the 20% net IRR for strategies that we've launched during periods of dislocation, and we've seen significant similarities to those time periods in today's environment. There are some differences. Again, commercial real estate being more at the epicenter this time around versus residential credit, more of a dislocation in private markets than public assets. Now, key distinction that ties these markets together, though, is that the types of assets are the same. It's the wrapping that's different. Before, you were able to buy these assets in bond form. Today, you're buying them in loan form and taking advantage of that tightening in public markets and selling them to public market participants at those tighter levels. And finally, all of this is encompassed and supported by PIMCO's institutional infrastructure and integrated investment platform. We benefit from PIMCO's macro expertise with Dan Iveson, Group CIO, Executive Chair of the Bravo Investment Committee. He's ensuring that lineage and that connectivity to how PIMCO is thinking about the macro environment fully is appreciated and incorporated into Bravo as well. We are also benefiting from the portfolio construction, the financing, the analytics, all key elements to capitalizing on a asset-based and real estate-based opportunity set. So as we look at this opportunity going forward, we think this is one of the best opportunities we've seen in the last decade to deploy capital towards these segments. We're incredibly excited by the environment and are already seeing multiple opportunities within the pipeline to which to deploy capital. Thank you very much for your time. I'm happy to take any questions.
All right, so with that, we're going to go to council questions for either our staff, Axia, or the representatives from PIMCO.
So this is Kathy, and I just want to make a comment on PIMCO. Bill Thompson is a longtime friend of mine. We were in college together, and he was your former chairman and CEO, and has been terrific at supporting things at the University of Missouri. And I don't know if any of you know him or knew him when he was your chairman and CEO, but he's really a great guy that understood not only the excellence in finance, but also about giving back.
Well, thank you so much for saying that. We 100% agree. Bill Thompson remains a very close friend of the organization. I happened to see him about 2 weeks ago and asked him about how his autism charity is going there with the university. And, he's just a tremendous resource for our firm. And I actually still have family that lives in Columbia, Missouri, and attended University of Missouri. So it's an institution near and dear to my heart. But thank you for your comment.
Well, terrific. And for those on the call, Bill gave the initial, he and his wife, to set up the Thompson Center for Autism. And it's created a center, a multidisciplinary center. In fact, it's been modeled by other universities since then, to provide help and support and treatment from everything from the medical side to the, educational side and everything. And he's been acknowledged by the university for his contributions. But tell him hi next time you see him, all right?
Absolutely. Thank you so much for your comments. I'll mention it.
Kathy Allen, A-L-L-E-N. So.
Thank you very much. Yeah.
Thank you, Member Allen. Great. So further questions or comments from council?
Well, this is Lee. I've got a question, but it's not to anybody you said I could ask a question of.
Why is that, Member Ross?
Well, you didn't say I could ask. You said I could ask one of the staff or the presenters, but I wanted to ask Senator Jennings a question.
Oh, go for it. I'm sure
Okay.
he's primed and ready.
And this really has nothing to do with this particular investment. Maybe just a little history. But back in the late '80s and early '90s, Senator Jennings, maybe you remember that we had some considerable discussion in the legislature regarding Allianz. I just remember asking if you remember that and if you were satisfied with the resolution. I know it doesn't have anything to do with PEMCO these days, but I just wondered what your perspective was.
Oh, I don't know. I've slept too many times since then.
All right.
I'm not gonna. I'm right. Just let the sleeping dog sleep.
All righty. Thanks.
See, your memory is too great.
Thank you.
Yeah.
Anyone else? Do we have a motion?
So moved.
Hello?
And you'll have to read the documentation, unless you need it from the investment committee. And I can second.
Okay. No, I don't need it from the investment committee, Member Allen, but if you'd like to make the motion and you've got it in front of you, that'd be great.
Well, all right. Let me find it. Let me find it.
So it's the second page of the. Yeah.
I'm happy to do it if you want me to.
Yeah, if you would, I don't have it in front of me, and it may take me longer to find it than necessary. I'll just second it. You go ahead and do it.
All right. Thank you, Member Romero.
Based on the recommendations of the Council Investment Committee, Fixed Income Advisor AXIA, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve commitment of up to $100 million to Simcoe Bravo 4 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you, Member Romero. And Terry, the way that we will record this is because Member Allen wanted to make the motion. We'll call that her motion and a second by Member Romero.
Great, thank you.
Okay, so is there any discussion on this motion? All right, with that, we're going to have Terry call the roll on a motion to approve an investment to PIMCO Bravo 4 LP.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg. Lee Rothman.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Kathy Allen.
Yes.
John Bingaman.
Yes.
And Treasurer, I'll go back to you.
Yes. Thank you.
A unanimous 8-0 decision. Madam Chair.
Okay, thank you very much, Carrie. And thanks to the folks from PIMCO that were on with us today. All right, we're moving on to our second fixed income investment recommendation, Strategic Value Special Situations Fund 5. Mr. Sable, over to you again.
Great. Excuse me. Thank you, Madam Chair. The New Mexico SIC staff, in consultation with its specialty consultant Axia, recommends a $100 million commitment to the highly sought-after Strategic Value Special Situations Fund 5. Joining me on the call today from Strategic Value Partners, David Greenberg, Managing Director of North American Investment Team, and Ryan Floor, Director of Investor Relations. The firm is headquartered in Connecticut and was founded by CIO Victor Kolsa. They maintain a global presence with key office in London and others in New York, Madrid, Tokyo, and Dubai. Staff believes that the general partner is well positioned to identify and execute on the superior risk-adjusted return opportunities that are expected to present in North America and Europe in the aftermath of the COVID-19 pandemic. These two geographies normally represent about 90% of the fund's investments, and those investments are split generally approximately evenly between them. The fund pursues a distressed influence/control strategy that leverages the firm's strength in deal sourcing as well as in the execution of complex restructurings, both financial and operational. This control and influence-based approach provides Strategic Value Partners, LLC, the opportunity to drive capital appreciation by optimizing the value of options embedded in the restructuring process and ultimately through operational control of targeted businesses. Importantly, this emphasis on control also confers risk mitigation benefits as well. From a portfolio construction perspective, we expect the fund will be concentrated into about 15 to 20 influence positions, accompanied by some 40 to 80 smaller positions that are the seeds of future opportunities. The typical asset mix for the fund's predecessors is 60 to 85% senior debt, 10 to 15% subordinated debt, and the remainder post-reorganization equity. Predecessor funds in this series have been top performers, and we believe the combination of talent and opportunity should allow Strategic Value Partners to generate gross IRRs in the 15 to 20% range, consistent with the somewhat higher risk profile of distressed investments. Staff believes the fund would be an attractive addition to the private credit portfolio. With that, I'll turn the floor over to Jen to cover Axia's underwriting.
Thank you. I'll keep this one short. So for SVP, we're fairly bullish on the distress and special situation strategies. I think we've been talking about this for some time. We believe that we can continue to see more opportunities really in the aftermath of COVID-19. And so we want to continue building this part of the portfolio out. In fact, we're actually already seeing strong performance in the true distress and special situations focused managers already held within the non-core fixed income portfolio. And going forward, we believe that Strategic Value Partners is another firm that's very well positioned to take advantage of the opportunities that we especially like their expertise in Western European markets, which we expect to be very complementary to the current investments that are primarily focused in the U.S. And finally, I think, Keith mentioned we've been working with SVP on a fee deal we're very pleased with, and this will certainly reduce the fees that New Mexico will pay on this investment. So we're also very pleased with that. I'll pass it over to Leo Fletcher-Smith to discuss our due diligence and view of the manager.
Thanks very much, Jen, and good morning, everyone. I lead Axia's European private credit research team. My team did led the diligence on this particular fund. I may echo a few of the comments that Keith made, but I guess if we start with our overview, SVP, an established manager which is focused on credit-oriented investments within the corporate distress space. The firm was founded in 2002. AUM now, I think it's just over 10 billion or so. The business was initially set up focusing on its flagship hedge fund program, which invests across both liquid and illiquid, event-driven and distressed credit opportunities, although more recently the GP's balance of AUM has shifted towards its closed-ended strategic value special situations program, which features a greater prevalence of illiquid and deep distressed investments. We've known the manager probably for over a decade or so through both the SVSS series and through its hedge fund program through our separate hedge fund practice, Over the past year, we've diligenced 2 commingled funds, and we're currently also diligencing a segregated mandate for a single client. So it's a platform and a strategy that we know very well. To echo some of Keith's comments in terms of the profile of investment activity, Fund 5, which we're looking at here, will target predominantly illiquid, distressed corporate credit investments with a focus on core asset-heavy sectors. As Keith mentioned, similar to predecessors, we expect the fund to comprise a diversified portfolio of somewhere in the region of 60 to 100 positions spread across Western Europe and North America, but also to feature a number of more concentrated, control-focused positions, which are likely to determine to a certain extent the overall performance of the fund. In terms of the target return profile, it's expected to sit towards the upper end of the credit spectrum, so 20% gross IRRs and at 2 times gross multiples. What do we like about it? Well, over the course of a 20-odd year track record, the GP's established itself as as a very credible player within the distressed landscape, with a particularly strong franchise in the European market and a particularly strong track record in executing complex, deep distressed investments. If we look at the past funds in the SVSS series, they've consistently been some of the strongest performers amongst global peers, both on a multiple basis, with net multiples typically in the 1.7 to 1.8 range for mature vintages, and on an IRR basis with net IRRs relatively consistently in the 13 to 15% range. As you'd expect, we've examined the track record through a number of different measures and metrics, including detailed IRR attribution across a broad range of different factors, detailed loss rate analysis, performance sensitivity analysis, etc. And generally, all of this analysis supports the view that the GP is consistently one of the top performers amongst peers. We would also note that we performed detailed case study reviews for a number of recent and older positions, and including both outperformers and underperformers. Conclusions from these reviews suggest both high-quality underwriting and a sophisticated approach to actioning and managing investment. In general, we view the SVP platform as being both highly focused and well-resourced, with expertise across a range of functions which are or should be critical to executing complex, distressed investments. As we touched on, the GP's long track record and activities spanning both liquid and illiquid credit creates a potentially powerful credit engine, which should confer benefits with respect to future sourcing and underwriting activities, and should provide the GP and the fund with the ability to participate in differing phases of the post-COVID opportunity set. Overall, we think the market opportunity and economic disruption in the aftermath of the COVID-19 pandemic has the potential to be pronounced. And in this context, we think SVP represents a high-quality investment platform which should be well positioned to capitalize on stressed and distressed credit opportunities. I hope that's been a helpful overview. I'll now pass things over to, I believe, David from SVP.
Hi, this is David Greenberg speaking. I head the North American corporate investment team for SVP. I've been with the firm for 12 years since joining Goldman Sachs, where I worked in private equity. First off, I'd like to say thank you to both Axia as well as to the Council for the due diligence work done with us to date and for this opportunity to present to the State Investment Council. The team at SVP would be absolutely honored to partner with the state. We've been asked to keep this presentation relatively brief, so I'm going to try to do just a few slides from our presentation, and then we'd be more than happy to answer any questions. The slides that I'll be speaking from are slides 6 through 8 of the presentation materials that we provided. Starting on page 6, the overview of the firm itself. SVP Global just came up on our 20-year anniversary as an institution. Our founder and CIO, Victor Kosla, started and ran the first distressed debt business for Merrill Lynch in the 1990s, and he's a 30-year veteran of the industry. As you'll see in the upper right-hand portion of the slide, we had about $11 billion of assets under management as this went to print. We actually just completed the first close on Fund 5, the subject of discussion today, last week, and so that AUM number is a little bit closer to $15 billion today. Getting to the bottom line, within the special situation space, SVP SVP is known for two things, really, that differentiate us from our peers in the industry. The first off is the strength of our European platform. SVP was one of the earliest entrants in the special situations market in Europe. And over time, that's brought us both geographic diversification as well as some really strong investment opportunities. Today, Europe makes up about half of our team as well as our portfolio. And as one outside data point, SVP won the Best Distressed Investor Award from EuroWeek for the last 6 years. And that's done by a vote of our peers and Wall Street professionals. The second is our business model, which sets up SVP as much more than a trading firm. Our specialization, when you really cut through it, is investing into middle market companies, helping them work through restructuring, and then to grow their businesses by bringing in a full operations improvement team on the back end. We do all of that with a purpose-built investment team that's set up to partner with banks and other credit institutions on the front end of the investment process and companies on the back end. We don't see any of our competitors doing that at quite the same scale. That business model is critical. As we've all seen, financial markets have traded back up post-COVID-19. Equities markets, a lot of the performing credit space, are back up to pre-2020 levels. But the hard work of actually helping to fix companies that were impacted by this economic situation is still in the early innings. There's a huge opportunity there. By the math, we think it's a once in 10 year or so kind of investment landscape for the strategy that we follow. I'll come back around to that really quickly at the end of the presentation. Page 7 is our team and our business model. The senior team here at SVP has been together for a long time. The names in bold across the top portion of this page manage the different areas of the investment team. We've been together at SVP an average of 12, 13 years. I'll quickly go through this page that shows how we organize the firm for this business model of investing in distressed middle market situations. The left-hand column is our sourcing team, which manages the way that we originate distressed debt opportunities. Kevin Leiden, who heads that group, managed the distressed trading businesses of Merrill and Credit Suisse in the US and Europe pre-SVP. So we have great relationships on the street. But the special sauce of that function is really that the whole team is set up to buy directly from banks and other sellers. A majority, generally 50 to 60%, of everything that we've purchased in recent years, we bought direct from owners of risk, banks, credit institutions like CLOs and mutual funds, without going through Wall Street. That opens up a much larger opportunity set of deals than from peers who only buy through the street, and allows us to step into these positions of influence or control that can be really interesting drivers of returns for the funds. In the center is our investment team, which leads due diligence and oversees the restructuring work. That team has expertise in middle market restructuring transactions and in a wide range of industries, like industrials, power and renewable, and infrastructure. But there are some sectors that we tend to avoid, like technology and energy. The right-hand column is our operational improvement practice, who work with the deal team in a really integrated way to deliver improvement inside of the companies where we have control or governance on their boards of directors. We think in some ways, perhaps the best proof of that team's success is in the performance of the portfolio in 2020. In 2020, through the funds, SVP controlled 9 businesses with a total of about 15,000 employees. In all of those, our operations team was deeply involved. Those companies were able to actually grow EBITDA in 2020, in total by about 30% from COVID-19. Page 8 then highlights the investment performance across the different funds over the 12 plus years history of the special situation strategy. The punchline is that the things that we've described have translated into performance for our clients and partners. In 2020, returns were very good, with the recent fund vintages up 15 to 23%, and the older funds up much more, although I wouldn't overly focus on fund 1 or 2, which were down to the last 1 or 2 investments, which performed exceptionally well. You see consistently across our funds over this period now returns of 14 to 16% net of fees, with our most recent Fund 4 being quite a bit higher at 24%. Even more important, though, to us are the net multiples of invested capital, which are already approaching 2 times for the earlier vintages. With projected future performance, we expect Funds 1 to 2 to end up at around a 2.2 times net multiple, and Fund 3 even closer to 2.5 times net multiple. One last thought. Since 2009, this has all been invested in a market environment without a major economic cycle. Right? Fund 1 was invested during the Great Financial Crisis. We won't pat ourselves on the back too well for the performance of that fund. But Funds 2, 3, and 4 were invested outside of any major economic event. I'm not going to walk through more of the presentation. Some of the later portions of our deck frame the views on the market opportunity. But as of today, the 2-year total default rate in U.S. high yield from 2020 to 2021 is projected to be about 11%. And given how large credit markets are today, about twice the size that leveraged credit markets were prior to the financial crisis, we focus on about $7 trillion of markets in the U.S. and Europe. We think the current environment is second only to the financial crisis in terms of opportunity to invest in restructuring businesses in the last 20 years. As a result, we've invested about $6 billion as a firm since the beginning of 2020, including a little less than $2 billion year to date in 2021. Those investments have been going into middle market companies in the sectors where we have experience. We see really attractive potential returns to continue this opportunity, partnering with middle market businesses through their recovery and growth post-COVID-19. Thank you very much for your consideration. That ends the prepared portion that I've set for the presentation today. I'll turn it over to Ryan Flory from my team on the SEC side to wrap up, and then we'd very much welcome any questions.
Thank you, David. Very helpful. This is Ryan Flory. As David mentioned, I'm a director on the investor relations team. Just want to echo David's comments and thank the council, and thank you to Axia for their support as well. Very briefly on the Fund 5 raise, as David mentioned, we did hold a first close on a Friday in the $3.7 billion range, and we do expect to hold a final close here in 2 months or so at the hard cap of $5 billion. So we're very, very pleased with the initial interest on the first close, and we have quite a bit of momentum heading into final close in a few months. I think at that point, I think we should just open it up for Q&A.
All right. So thanks to the folks on the line from SVP for joining us today for questions. We'll go to questions from council. And I'm not going to say to whom. You can ask of anyone that is on the line. Any questions from council? Comments, recommendations, requests, commendations, criticisms? All right.
Does the criticism have to be related to anybody that's on the line?
Has to be related to this particular investment recommendation, Member Rawson.
I always have other thoughts. Thanks.
All right. I guess you did a good job of presenting the information, so we will move to a motion. Do we have a motion?
Yes, it's member.
Go ahead and I'll make the motion.
Thank you. This is Member Messina.
Very good. So we have a motion from Member Messina. Do we have a second?
I'll second. I'll read the motion.
Member Romero for a second. Thank you.
Sure. Based on recommendations of the Council Investment Committee, Fixed Income Advisor Axia, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approves commitment of up to $100 million to Strategic Value Special Situations Fund 5, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
All right, so that's a motion from Member Messina, a second from Member Romero. Any discussion on the motion? If not, we will have Carrie call the roll on a recommended investment to Strategic Value Special Situations Fund 5.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Lee Rothman.
Yes.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Kathy Allen.
Yes.
And John Bingaman.
Yes.
There you go, an 8-0 unanimous approval.
All right, thank you, and thanks to the representative from SVP on the line to take our questions. Okay, with that, we're going to go to the redemption recommendation and agenda item 3F. Mr. Sable.
Thank you, Madam Chair. The New Mexico SIC staff, in consultation with Axia, is recommending a full redemption from the Angelo Gordon Rio Grande flexible multi-credit portfolio. As of the end of February, that portfolio had about $137 million in assets. Originally part of the ATO's fund of funds, the Angelo Gordon portfolio was moved into the Rio Grande structure separately. The fund was first allocated capital in 2013. The portfolio's mandate included investing opportunistically across a variety of credit instruments, including commercial and residential, consumer securities, bank loans, asset-backed securities, including residential and commercial mortgage-backed securities. CMBS and RMBS have historically been the largest portfolio exposures. Since the inception of the investment through January of 2021, the strategy has returned 1.8% annually, which is below our return expectations, both on an absolute and also from a risk-adjusted point of view. The key components of the strategy are well represented across other parts of the portfolio, and we believe that better opportunities exist in those areas. As a result, staff recommends full redemption of our investment in that Angelo Gordon Rio Grande flexible multi-credit portfolio. I will turn the floor over to Dylan Herman from Axia, who will step in for Jen.
Hey everyone, thanks for the time. Just to quickly introduce, my name is Dylan Herman. I've helped Jen Wildman support the New Mexico relationship at Axia for the past 2 years, but this is my first time presenting to the council. So, hi everyone, thanks for the time. Just for a quick overview and just supporting what Keith has already said, the recommendation on our side is redeem in full. This SMA is a legacy position that was set up as part of New Mexico's fund of funds relationship many years back. Prior to March of last year, Angelo Gordon was performing within their target range of about 6 to 8 per annum. However, March 2020 had a significant impact on the portfolio, and it performed more poorly than we would have anticipated. Last year, they've come back a bit in terms of performance, but the impact was fairly severe, and as such, the annualized returns since the life of the fund was about 2% through February 2021. While performance has not been stellar, the primary purpose for redeeming that we feel there are more interesting opportunities and structures that better fit the non-core fixed income portfolio. That's all we have, and I'm happy to answer any questions or provide additional detail as needed.
Okay, with that, we will go to council questions on the redemption recommendation.
I will. This is Member Messina, Madam Chair.
Okay.
That motion.
And Madam Chair, I'll second, and I'll read the motion.
Very good. I appreciate that. So we have a motion by Member Messina, a second by Member Romero.
Based on the recommendations of the Council Investment Committee, Fixed Income Advisor Axia, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a full redemption from the Angelo Gordon Rio Grande Flexible Multi-Credit LP as memorialized and discussed by the Council at today's meeting.
All right. Any discussion on that motion? We have Carrie take a roll call vote on the staff recommendation, agenda item 3F.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Lee Rothman.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Kathy Allen.
Yes.
And John Bingaman.
Yes.
Thank you. A unanimous approval, 8-0.
Great. All right, so our last item on fixed income, we do have investment contract matters to handle, I believe 2 terminations and 1 renewal. I believe those are all separate votes. So we're going to hand it over to Vince to explain, and then we'll take, I believe, each action separately with a separate vote.
Great, thanks, Madam Chair. So last week, we discovered that we had 3 investment management contracts had expired on us. And so after we developed some information around that, our management group thought we should get that in front of you as quickly as we could. So that's the main reason that for this late addition to your agenda. The materials that the Commissioner referenced are in the back of your book. Just the last few pages of your book. You should see a recommendation from staff and also from the consultant RBK for each of the funds or for each of the portfolios, and then a memorandum from me on the expirations and some information there on those for you. So we have 2 things to do here. First is work through the 3 recommendations that we have on the managers. And then we'll cover the lapse in those contracts and some ideas on what we might want to do to address that. So first, with the 2 bank loan managers, let me give you, that's Voya and Credit Suisse. Let me give you just a little bit of background on that for some context. We brought those in the portfolio in 2013. Both were really good very good strategies, had above expected returns. But in 2018, in the fall, these securities have really valued up, and our forward-looking return expectations were fairly low from them. So we moved most of the money out of these strategies on a rebalancing basis, rebalancing them into some things that looked a little bit better to us. One in October of 2018, the other in November of 2018. Our timing couldn't have been better by fortune, because in December of 2018, the next month, stock market dropped 20%. These securities spreads really widened out. Prices, of course, dropped to make that happen. And since then, except for a very small window after the market bottomed there in December of 2018 and started bouncing back up, except for that very small window, we just haven't found the opportunity to rebalance capital back into these strategies. And still today, we find ourselves in an environment that they just don't look as attractive to us as other opportunities we have in the portfolio. So the recommendation on each of these is to liquidate these portfolios and close the accounts for these bank loan strategies. Now, we don't want to close the door on perhaps coming back in the future for this strategy, and of course that would entail a full RFP and operational reviews and the things we normally do when we bring a manager on, and of course bringing it before you for approval. So it's just that this time the strategy just doesn't look so good, and the amount of capital that's in these is pretty small, and I think we have better opportunities for that capital. So that's the basis of the recommendations on the bank loan portfolios. Madam Chair, do you want me to cover JPM, or do you want to do a base on?
Let's see if there are first any questions on the cancellations, the terminations. I'm sorry. So I don't know if folks have these motions in front of you. If someone is willing to make a motion, as a chair, can I read the motion out? Is that proper? Is anyone?
Well, I don't see what. This is Member Messina. I don't know any rule that prevents that. I'll make. You can provide the wording for me, please.
Okay, so Member Messina, are you willing to make a motion?
Yes, I am. But I need help with the wording. Yes, thank you.
Okay, so we're going to start with Voya. This is the first recommendation for termination. Based on the recommendations of General Consultant RBK and SIC staff, I move that State Investment Council approve the liquidation and account closing of the bank loan strategy managed by Voya Investment Management. So we're going to call that a motion by Member Messina, and I will second it. Is there discussion on that motion? I'm going to have Carrie call the roll on a motion to terminate our bank loan strategy with Voya.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Lee Rothman.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Kathy Allen.
Yes.
And John Bingaman.
Yes.
Unanimous. 8-0.
Very good. Thank you, Carrie. Member Messina, are you willing to make a motion as well on the Credit Suisse termination?
Yes, I would like to make that motion, please.
Okay. So we have a motion from Member Messina, and I will read out the motion. Based on the recommendation of General Consultant RBK and SIC staff, I move that the State Investment Council approve the liquidation and account closing of the bank loan strategy managed by Credit Suisse Asset Management. So we've got a motion by Member Messina and a second by myself. Do we have any discussion on that motion? All right, with that, we'll have Carrie call roll on the motion to terminate our bank loan strategy with Credit Suisse.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Lee Rothman.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Kathy Allen.
Yes.
John Bingaman.
Yes.
8-0. Unanimous again.
Okay, thank you, Carrie. Vince, now we'll go on to the renewal.
Okay, thanks. So the JP Morgan strategy is a short duration strategy in the fixed income portfolio. It's primarily there for liquidity. Performance has been very good, and during the pandemic, particularly last spring, the strategy was very valuable to us in terms of providing liquidity for other parts of the portfolio when we needed it, and also on an opportunistic basis to make investments during that time when markets had fallen quite a bit. So we very much want to renew this manager, continue with this strategy. It's also fairly large. It's about $800 million with this manager, and they're highly professional investment management shop. So our recommendation is to continue this contract for 4 more years.
Okay, so we're going to go to council for questions on this particular recommendation. To renew our investment management services with JP Morgan for an additional 4 years. Do I have a motion?
Yes, this is Member Messina, Madam Chair, and I would like to make the motion.
Thank you. Member Messina, is there anyone who would like to second that?
Tim will second it.
Can you read it out, Member Jennings?
No, I don't have it before me.
All right. Okay, so let me just read it for the on behalf of the council and for those folks listening in as well. Based on the recommendation of General Consultant RBK and SIC staff, I move that the State Investment Council approve contracting with JP Morgan Investment Management for investment management services related to the short duration fixed income portfolio as discussed today. And Carrie, we're going to call that a motion by Member Messina and a second by Member Jennings. Any discussion on that motion? All right, Carrie, would you call the roll?
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Lee Rothman.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Kathy Allen.
Yes.
John Bingaman.
Yes.
8-0, unanimous.
Great. Thank you, Carrie, and thank you to Vince. And we have concluded the investment matters portion of our agenda. Thank you all so much. With that, we're going to move on to finance matters and turn it over to the audit committee. Steve, I'm not sure who is presenting there.
Nick, would you conduct that for us, please?
I don't believe Member Tejas is on.
All right. Just one moment.
Steve, I'm happy to cover it if you want.
All right, Brent, and then Lee can comment on whatever is appropriate.
All right. The audit committee met yesterday at 10 a.m. Telephonically. It was decided by the members of the committee, and just so everybody knows, the members are Nick Tejas, Lee Rawson, and the advisory member, Mike Everett, that Nick Tejas would be the new chairman of the audit committee. Much of the time during the committee yesterday was spent talking about the fiscal 22 preliminary budget. I think the discussion went overall very well. A little bit of time was spent on talking about the budget to actual March materials, as well as the investment holdings report, which was touched upon briefly. The other items, the main items that were discussed at the audit committee yesterday, were in the process of receiving responses for an RFP for audit services, and the deadline for receipt of those replies, May 7th. And so far, we have 6 firms that said that they're going to respond. That doesn't necessarily mean that they will, but at least preliminarily, we think there can be up to 6 firms that will respond to that request for proposal. Once those responses are received, we'll organize a review committee and review and score those, and then a recommendation will be made back to the audit committee. And then lastly, I think during the last meeting of the audit committee, there was a discussion of the potential of having a penetration testing of our IT systems. We're in the process of receiving some cost proposals on that. And again, once we get those and review and make a recommendation, we'll present it to the audit committee so they can decide which direction they want to head. Other than that, Lee, if I missed anything, feel free to correct me.
No, I think that's an accurate summary. Maybe there's considerable discussion about the reduction in our budget, not so much in terms of amount of the budget, but in terms of the FTE reduction. We're concerned with the agency being able to get the job done with a cut down to staff level, I think 26.
Yeah, I'm glad you mentioned that. One of the things that happened during this last legislative session, for the fiscal 22 budget, there was a cut in our headcount from 31 to 26. And as a result, the appropriation request had some cut in the payroll area, which is category 200. And we maintain our concern for that. I guess we'll see how fiscal year 22, once we get into it, shakes out. I'm kind of under the opinion, and I think we got to this point in the committee. If we get to the point where we need to hire above the 26 head count, I have talked to our DFA analyst, and he assured me that there was a mechanism through maybe a budget transfer and other processes that we could get those positions added back. I think the executive area decided that, for all agencies, and not just us, there were some positions that were vacant for a longer period of time. There hadn't been any movement on those positions. And because of the pandemic, that certainly hasn't helped the process. But because there hadn't been any movement on the positions, they decided for the agencies that they were just going to deactivate some of those positions. So I think in the future, if we possibly need to add some additional positions, and we might very well, especially as we return back to the office, we'll be able to do that through a budget transfer. And then continuing on, Madam Chair, to my presentation, I'm on page 377 of your diligent material. I just wanted to point out a couple of things as I typically do on item 1, our budget to actual. That information is included through the end of March. It's a quarter end. We're not experiencing any budget problems and don't anticipate any problems through the end of the fiscal year. I think we'll end the fiscal year in fine shape. The investment holdings report, I did want to point out on, I think it's page 446. Let me get to that. The holdings report. I'm having trouble navigating here. Go back. On page 446, I did note, as I always do on my notes page, the contribution from the land office for the month of March. As the land commissioner has pointed out, these amounts coming in are lagged by about 3 months. So the amounts that you're seeing there within March would be for December. And the amount was $90.8 million, which is an increase of $12 million over February. For year-to-date or prior year comparison purposes, the prior years was just a little over $100 million. And then also wanted to point out on the 4th bullet there, the Small Business Investment Corporation value as of the time that the IHR was prepared was $39.1 million. And then, or I'm sorry, I think I looked at that, it was $97 million. And then the Small Business Recovery Loan Program is valued at $39 million plus an additional $1 million that we contributed for the month. And then other than that, I have included the preliminary budget for fiscal year 22. I think it was endorsed by the audit committee. I'm happy to entertain any questions that anyone might have on that. I think I've pointed out before, the only cut that we had in that appropriation request was the fact that they did delete some of our head count. So the category 200 total was cut a couple of $100,000. The request that we made for the category 300 total and category 400 total was exactly what we requested, especially within the category 300 total. It provides some flexibility as we go forward because we have fee estimates in there, and usually we're a little bit more conservative in those estimates. And because we will have some potential overage in that, that will allow for the possibility of doing category transfers to the 200 category, which is payroll, should we need that. Other than that, that's all the comments I had, unless there's questions.
Great, thank you, Brent. Questions on the audit committee report, CFO report from council?
Madam Chair, I don't have questions, but I do have a comment, and it's about the budget. And so what he just explained is absolutely true. The recommendations that came forward this year, if there were, if we saw that positions weren't being filled, if there were vacancy savings, because, you know, the fact that we were reducing agencies' budgets, that those were all taken into consideration. But there are opportunities to move money from one category to another category if, in the event that they do need to hire additional employees. But we believe that with the vacancy savings that they have, that they should be okay. But we are available to help them if they need that assistance.
Thank you for that clarification, Madam Secretary. Further questions from council? All right. Do we have Evan Land on the phone?
You do, Madam Chair. Can you hear me?
Yes. So we're going to agenda item 4C, which is, I believe, legal services contract extension.
Yes, Madam Chair. Thank you, Madam Chair, and thank you, council members. This is Evan, and staff is very appreciative and thankful for everyone's time after a very heavy agenda.
Excuse me, Evan, I'm sorry. This is Tim, and I have to leave. I have an appointment I have to go to. I'm sorry.
Well, that's okay. Thank you, Member Jennings. So what you have before you, council members, is a contractual relationship that the council has obviously seen before. Staff has brought it because we bring all contracts that have a value of more than $50,000 to the council. And this is a tool by which staff, and we do a lot of this work in-house, but that we best comply with your votes with respect to particular investments that are subject to legal terms and legal review. Obviously, we are now at a $30+ billion fund, and for example, today there were 4 private market, very sophisticated, somewhat complex, diversified investments that came through in the aggregate of $340 million. And ICE Miller is obviously a mechanism that we use to help safeguard the council's rights and our beneficiaries' protections and so forth. There is a pretty detailed, and I appreciate your patience with that memo, in the materials that begins at diligent page 450. And I'm happy to answer any questions or any concern, address any matters that the council would wish to do. And I will stop now and wait.
Evan, why don't you give us the high-level cost and how long are we extending for?
This would be a 4-year extension. I'll go in the opposite order. Thank you, Madam Chair. The cost is, we've asked, it's under $800,000 a year is what we've asked for over the course of 4 years. We don't anticipate potentially spending all that. We hope not to. Again, we do a lot of work in-house. Just by way of background, I've been here about 10 years, and the legal department has somewhat changed as we've embarked on a much more diversified asset allocation strategy due to private market equity risk primarily. I think when I started, the legal expenditures for the prior year that I wasn't here was about $6 million. We've reduced over time to then $2.5 million, further down to about 1.5, and currently we're about 1.2. If you happen to look at page 380 of the diligent materials, that's Brent's budget to actual. This year alone, we've only spent about $418,000 on the whole legal side. However, as the funds grow, as we bring, for example, 4 private market investments this month, there have been months when there's 6, under $1 million a year, significantly under that, in our mind would be a very responsible and frugal expenditure to protect the permanent funds.
Thank you for that. Further questions from council? Okay, we're going to need a motion and a second on this particular recommendation for the legal services contract amendment and extension. If someone is willing to make the motion, I can read it out.
This is Member Messina, Madam Chair, and I would like to make such a motion.
Okay, we've got a motion from Member Messina. I can go ahead and second that. And the motion is as follows. Based on and consistent with the recommendation memo set forth in the public meeting materials, I move that the State Investment Council approve the amendment and extension to the ICE Miller investment-related legal services contract. So we've got a motion by Member Messina, a second by myself. Any discussion on that motion? Okay, if we could have Carrie call the roll.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Steve Watson.
Yes.
Mike Messina.
Yes.
Kathy Allen.
Yes.
John Bingaman.
Yes.
With the departure of Mr. Jennings, it's now a 7-0 unanimous.
That's before the council. All right. Our next SIC meeting is going to be Tuesday, May 25th, I believe telephonically, unless we hear differently. And it may be that we get to see our fearless leader again back in the chair's chair. In the midst of this meeting, we had a fire drill here at the land office. So I had to chair during a fire drill. We're going to go now to public comments. I'm going to turn it over to Charlie to read any public comment that the council has received.
Thank you, Madam Chair. We did receive one public comment this morning. I'll go ahead and read that. It's not overly lengthy, but I'll read it and then we will forward it to the members of the council as well. So this is good morning, Chair and members of the council. My name is Jim Baker with the Private Equity Stakeholder Project. The New Mexico State Investment Council is an investor with private equity and real estate firm, the Carlyle Group, and is considering a commitment to Carlyle's new real estate fund, Carlyle Realty Partners 9, at its meeting today. Affiliates of the Carlyle Group have filed more than 200 actions to evict residents of the firm's properties during the COVID-19 pandemic, including 165 eviction filings since the CDC eviction moratorium took effect in September 2020. In order to protect Americans from contracting and spreading COVID-19, the U.S. Centers for Disease Control and Prevention recently extended the national eviction moratorium through June 2021 and noted that $52 billion in federal rent relief has been set aside for an estimated 12 million renters who owe back rent. Despite the CDC eviction moratorium, the Carlyle Group has continued to file and advance residential eviction cases. A number of these cases are complaints for non-payment of rent, which are specifically covered by the CDC eviction moratorium. An organization violating the CDC eviction moratorium may be subject to a fine of up to $200,000 per event. Carlyle Group affiliates have not just filed eviction cases, but have removed some residents from their homes, including after residents had asked not to be evicted. For example, I have shared case documents from a resident whom Carlyle affiliate, CRP Crescent Lucerne, evicted in January, despite the resident citing a job loss and asking not to be evicted. In late March, the Federal Trade Commission and the Consumer Financial Protection Bureau stated that they would be investigating evictions by private equity firms and multi-state landlords. The FTC and CFPB noted, unfortunately, there are reports that major multi-state landlords are forcing people out of their homes despite the government prohibition or before tenants are aware of their rights. Depriving tenants of their rights is unacceptable. Many of the tenants at risk for eviction are older Americans and people of color who already experienced heightened risks from COVID-19. We have reached out to the Carlyle Group several times to discuss these eviction actions, but the firm has not responded. Many of the eviction actions filed by Carlyle Group affiliates are still active. It is up to the Carlyle Group to decide whether to move forward with evicting residents during the COVID-19 pandemic. Please ask the Carlyle Group to halt residential evictions during the pandemic and enable residents to stay in their homes and access the rental assistance available. In addition, please ask the Carlyle Group what steps it is taking to mitigate the regulatory and headline risk created by the firm advancing evictions in the middle of the COVID-19 pandemic and despite the CDC eviction moratorium. That is the end of the communication. Madam Chair.
Thank you, Charlie, and I'll just editorialize by saying it would be nice to have that public comment before we have the Carlyle Group on so that we can ask them those questions ourselves. All right, with that conclusion of public comment, we'll go to adjournment. Do we have a motion to adjourn?
I'll move that, Jaron.
All right, we've got a motion from Member Ross and any second to that motion.
Member Romero will second.
All right, is there any objection to an adjournment motion? All right, we are adjourned. Thank you, folks.
Thank you.